Something significant just happened in the U.S. Treasury market. The 30-year Treasury yield surged to 5.34%. This rate is the highest we've seen since 2007. In response, the Treasury doubled its long-term bond buybacks starting on September 9. This might sound technical, but it could have major implications for Bitcoin and market liquidity. Treasury announced it will increase buybacks for longer-dated treasuries. Previously, the maximum buyback was $2 billion. Now, it's at least $4 billion. The market reacted immediately. The 30-year yield fell to 5.18%. The 10-year yield dropped, and the dollar weakened. Simultaneously, stocks, gold, and Bitcoin rose. But here's a critical point. This is not quantitative easing, or QE. The Treasury buys existing bonds to enhance market liquidity. The Federal Reserve isn't creating new reserves for these purchases. Think of this as a warning shot. The Treasury is showing it will act when the long-term Treasury market gets shaky. Now, what does Japan have to do with this? The yen has faced pressure while Japanese bond yields have climbed. Japan has intervened to support the yen. If Japanese rates rise and the yen strengthens, the well-known yen carry trade becomes less appealing. Investors borrow in yen, convert to dollars, and buy higher-yielding assets. If conditions shift, that pressure can squeeze investors. We see dual pressure. Japan is stabilizing the yen, while the Treasury seeks to stabilize the U.S. bond market. Yet, the Federal Reserve is still on the sidelines. Currently, inflation remains a challenge. If it stays around 3% to 4%, the Fed faces tough decisions. Lowering rates would normally be off the table. But what if the 30-year yield rises further? If it hits 5.3% or more, the Fed's challenges multiply. Weak Treasury auctions, widening credit spreads, and rising unemployment could prompt the Fed to provide liquidity despite high inflation. This scenario significantly impacts our Bitcoin perspective. The key catalyst may not be just a rate cut. Instead, it could be stressed financial conditions prompting policymakers to act. So, what should we keep an eye on? Here's a rough gauge. A 30-year yield around 5.0% to 5.3% feels manageable. If it hits 5.4%, we'll start testing the Treasury's intervention. At yields between 5.5% to 5.75%, the likelihood of added Treasury action grows. If we touch 6% and liquidity worsens, that's when the Fed's response becomes really intriguing. Keep an eye out for upcoming data, such as the PCE inflation report on August 26. Continued inflation decline gives the Fed more leeway. Conversely, if inflation surges while the 30-year yield climbs, that's alarming. So today's $4 billion action isn't the main narrative. The real story is the Treasury's readiness to tackle long-end stress. If this stress recurs and escalates, forcing the Fed's hand, it could signal a macro event. For Bitcoin, this is the key scenario to watch, not just today's development but the future actions of policymakers. Thank you for watching. Click the like and subscribe buttons to stay informed.